Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by Paul Strome, Andrea Carpenter and Nicole Dines. Nicole, let's start with you. What's your pick of the stories this week?
Well, I've been looking at the UK market. We've seen for a while the prices have been going up and up, obviously driven, as we know, by low interest rates, availability of mortgages, and sort of people's desire to move and maybe go away from the big cities and look for some more space and green spaces. But it's really picking up because on the 30th of June was the last day of the stamp duty holiday. So there was a real rush to complete deals. So prices have been growing at the fastest rate in 17 years, according to Nationwide, is 13.4%. And in June alone, prices were 5% higher than in March. You know, the Bank of England said it was worried, said the real estate market was on fire, and fire is never a good thing for the Bank of England. But experts from Knight Frank to Saville seem to be pretty relaxed about it. They said that yes, the rate of growth will slow down, but it would be a return to normality and prices would keep growing, just not quite at that crazy rate. So there seems to be no worry of a crash or anything like that. And again, on the UK, I've been looking at the office market, particularly in Canary Wharf, because Barclays Investment Bank announced that it's going to move all its staff to its Canary Wharf headquarters. The good news in a way, because it's sort of back to the office, they say they've already got about 70% of their staff going back to the office regularly. But the bad news is that it seems to be shrinking office space. And it's the latest move in a sort of trend of shifting from scattered locations around to a campus model of just consolidating offices in one single place. The market at Canary Wharf is very much in flux because a lot of the original leases that were taken up by the banking giants, by the big names in banking, were signed in the 1990s and they're coming towards the end. Some of them have got less than 5 years to run. So it'd be very interesting to see what happens, to what extent they get renewed. So Barclays is not the only one to be consolidated into one office. Citigroup as well is moving from 2 buildings into 1 in London. And Credit Suisse is already subletting some of the space that it had hired because it's stuck in a lease, but it doesn't need all the space, so it's subletting it. So this seems to be a definite trend towards shrinking space in the office, but also people going back to the office. So some good news and some bad news.
Yeah, I noticed also Rishi Sunak, the Chancellor, saying that financial services deal with the EU hasn't happened. And it'll be interesting to see how that also, I think, has an impact there in terms of the city. Also more kind of negative news in some ways as well for the retail side, particularly looking at the UK and Ireland, with Gap closing all 81 stores. That had been trailed obviously earlier in the year where there was a little bit of uncertainty about it, but confirmation there that all 81 stores will be closed and that business will be moving entirely online in the UK and Ireland. We're still waiting to see what will happen in terms of the continental European stores and particularly Italy. But obviously some negative news there from the retail side. Andrea, what have you been watching?
Well, I've been looking at some better news from the retail side, which is the opening of a massive Lego store on Fifth Avenue in New York. It's going to be one of those retailtainment type places. And it's really about Lego wanting to say it's committing to all types of retail channels. So 100 more stores globally in 2021. So a commitment to bricks and mortar, or lots of Lego bricks and mortar in this case. And I think it's going to be one of those immersive experience places. You're going to be able to create your own Lego figure of yourself and have portraits of yourself and mosaic and things like that. And I think it's interesting that the distinctive brands can still cut through some of these retail issues. I mean, I don't know if you would liken Lego to Apple, but, you know, it's similar. It's great product design and the ability to offer that experience. You know, in New York, you're going to have to pay $130 to have a mosaic portrait of yourself in Lego within the store. So it's not going to be cheap. So we're almost, you know, are we retail store or are we theme park? And I think actually for some of the brands and for some of the major retail destinations, this looks like the direction of travel. My second story jumps from plastic to climate change, but Lego is also committing to kind of, sustainable sources for its plastic bricks. So AEW released a report this week on climate risk. They took a real analytical look at what the impact might be on real estate returns, you know, as we transition to net zero. And I think it's really important to see this kind of research, you know, looking at the business case for the transition. We know it's going to cost investors and investment managers money to do this. So we really have to have a better understanding. And what AEW did was look at different scenarios, the best case scenario being an orderly transition for the Paris Climate Accord targets. And in that case, actually with so much private and public investment into the transition, there would actually be GDP growth, which means like a positive impact on real estate returns. So on average, European real estate returns could be up 40 basis points between 2021 and 2030. But that versus sort of a disorderly kind of transition. So I think that's really interesting. And I think there's a hope also that technology will come to try and meet some of that more difficulty of reducing energy intensity as we go forward. But, the message for a fragmented industry is that we all have to get started now, really.
Yeah, and that came through very much in both of the sessions that we had around the outlook, but also looking at some of the infrastructure side as well, where obviously that new energy, carbon neutrality, is a major part of that. Paul, what have you been watching?
In the forthcoming Real Asset Insight magazine, we'll be looking in a bit more detail at infrastructure aspects of real assets, which are coming to the fore. Largely as a result of a number of environmentally dictated trends, not least a growing need for green electricity generation. And of course, there's the accelerating switch to electric vehicles, which demands not just developments in vehicle technology. And this week we saw Nissan declare it's going to step up EV production in the UK, but a more comprehensive means of charging them. The recent Real Asset Media Infrastructure Summit, Investing in New Energy, looked specifically at green power generation capacity and the options to choose from and the opportunities that it presents. One conclusion was that the government support for the sector will be needed until economies of scale accumulate. Although speakers pointed out that the economics of wind generation in Northern Europe are favourable, while the emphasis in Southern Europe is not unnaturally on solar power. On the other hand, the economics of carbon capture and green hydrogen production are less favourable at the moment. But the sector is getting involved, and in an announcement that illustrates some of these points, Commerz Real announced that it had bought its first Finnish asset for its Climavest Impact Fund. It's an onshore wind farm located in the Kaunas municipality in western Finland, and a total installed capacity of 58.8 megawatts. That's enough power for about 25,000 Finnish households. Commerz Real previously acquired a portfolio of 3 onshore wind farms in southern Sweden last September, but the fund's not wedded to wind. Only a few months ago, it announced it had acquired a portfolio of 3 solar parks in Spain for the Climavest Impact Fund again. That produces enough power for about 74,000 Spanish households. That was Climavest's second solar investment in Spain. Elsewhere, this week, Macquarie Green Investment Group announced it has formed a partnership with a Dutch fast charging technology company, Heliox, to start delivering electric bus and truck charging infrastructure across Europe. They say it's a charging as a service model. They'll own and fund the construction of charging infrastructure and maintain it. Initially, the target markets are higher growth EV markets, which is Netherlands, Belgium, Germany, and UK. And the JV said that the service reduces one of the main barriers to fleet electrification by removing upfront costs. Heliox has already developed the world's largest bus depot charging network at Amsterdam's Schiphol Airport. And it was recently selected to build the first bus depot in Glasgow, which will be the UK's biggest electric charging station. So there's progress.
Yeah, it's been really interesting to see, I think, that focus on real assets, so both infrastructure and also real estate. There's a lot of discussion as well around the amount of capital on the sidelines beginning to come in. And I noticed as well that Pantheon launched a real estate investment strategy and hired senior team members, Roman Bruslavsky and David Elliott, to establish and lead the new strategy. So interesting to see that new capital definitely coming in. And a very positive story this week as well from Athens, where the huge 8 billion Hellenicon regeneration project was given the green light and also began to get the first phase underway, with property developer Lambert Development paying the first 648 million instalment on its 99-year lease, partly supported there in terms of finance by Piraeus Bank. So really interesting to see that project, which has been waiting a number of years to come through, finally moving forward. Thanks very much, Nicole. Thank you, Andrea. Thank you, Paul. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the real asset markets.